The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody. It's just kicked off 3 minutes past 11, so we'll go ahead and get started. Thank you for joining us today. The webinar titled Investment Opportunities Beyond Nvidia, the Next Generation of AI Winners. We know this is such a topical topic at the moment, so we're keen to delve in it with Hugh Lamb, a brilliant addition to our investment strategy team to take you through today's topic. But of course, before we do commence, I must let you know that all advice is general in nature and it does not take into account your specific circumstances. Should you require that, please do seek out a financial advisor. Now, a little bit of a company update from BetaShares here. We're pretty pleased to have just ticked over $40 billion of assets under management. But what that means for us is over 1 million investors and over $40 billion of your money that we've been entrusted to take care of within your portfolios. And this is no small feat, and we will continue to do our absolute best by developing products. We've now got over 90 different products available for your needs as well. Now, of course, like always, the session will be available on YouTube once it's finished. And we do have a Q&A section towards the end as well. So at any point, if you have any questions, go ahead and hit those ones up. If we don't get time to answer them today, we will follow up and answer them towards the end as well. Now, finally, of course, as you know, our Insights newsletter is the #1 most read Insights newsletter from any ETF fund manager. If you haven't signed up yet, we've got a QR code on the screen. And of course, we are on all the major socials as well and love hearing from you all there. Now, with that in mind, I'll go ahead and pass it to Hugh to kick it off. Thanks, Hugh.
Great, thanks so much, Laura. I'm extremely excited to be here today and joined by so many of you who've registered for this exciting topic on artificial intelligence and technology. As Laura said, this is a theme that's been so topical on many investors' minds. And the reason why is because, IT, AI, and that thematic makes up such a huge proportion in equity markets, particularly in the US. So right now, it's really front and center given earnings season is currently upon us. Year to date alone, the S&P 500 is up 15% already, and over 60% of those earnings is contributed by the Magnificent Seven stocks alone. So this posits the natural question, has the US big tech run too far? I think we're at a really interesting inflection point in markets right now as to whether the earnings sustainability of these companies can continue going forward. There's a lot of political uncertainty with the elections coming up. There's also geopolitical concerns around the Middle East, which may weigh down on sentiment. So time will tell as to whether these stocks can continue grinding higher. So without further ado, let's delve into the Magnificent Seven. What makes them so magnificent in the first place? Why are they called magnificent? If we think about the seven names, Meta, Google, Apple, Microsoft, etc. These are all names that we are all familiar with. Nearly everyone in the world uses their products or services in one way or another. Think about the phone that you're using. It's probably an iPhone made by Apple. There are around 1.5 billion iPhone users out there. The laptop or computer that you're using to view this webinar is, most likely using the Windows operating system. And there's around 400 million monthly active users of the Windows 11 platform alone. When it comes to content creation and social networking, if you're watching cat videos on YouTube, that's owned by Google. And when you're talking to friends, whether it be through Facebook or Instagram, those applications are owned by Meta. So you can see how pervasive these names are to our everyday lives. They essentially have a license to bill every customer in the world, whether that be enterprise or an individual person. So bringing this in terms of a financial context, what this chart shows here is the total return of $10,000 if you invested in the Magnificent Seven stocks alone in 2015 compared to the ASX 200. You can see that there's been a significant discrepancy between the two indices. A 10K investment has translated to almost $230,000 in 2024, as opposed to 22,000 for the ASX 200. And we'll see throughout this webinar that a lot of that return has been driven by earnings growth and innovation. A lot of these companies are investing significantly in research and development, not just now, but in the past, which has allowed them to grow new business segments such as cloud revenues that has accelerated both earnings and growth. If we think about the one company though within the Magnificent Seven, I'm sure most people online knows this company, Nvidia. Nvidia is essentially the poster child of the whole AI thematic. It's been known for its advanced GPUs that the hyperscalers or the big tech companies like Microsoft, Google, etc. use to build large language models. But are there any lessons we can learn from the past? Some people might have heard of Cisco, and this chart shows how eerily close the price return series is between Nvidia and Cisco's. You can see that Cisco had an exponential rise from 1998 to 2000, leading up to the dot-com bubble, because Cisco was initially, it was viewed as the provider of networks and switches that was going to enable the internet revolution. But what we saw subsequently following the dot-com bubble was that Cisco's stock price fell 89%. And it was not only till late 2021 until the stock fully recovered. And you can see Nvidia from November 2022, it's had a similar exponential rise in share price, and it's come off a little bit. So there are questions as to whether the sustainability of Nvidia's share price can continue. There's almost a correlation between Cisco's narrative, valuations, and stock price to Nvidia's. Instead of Cisco being viewed as the enabler of the internet revolution, Nvidia is being viewed as the enabler of the AI revolution. And so investors are looking for those earnings to continue within their revenue streams. So the next question I wanted to talk about is whether Nvidia will remain dominant. So there are obviously other competitors out there in the market, such as AMD, Intel, and Google. These are other GPU providers which are in the market right now. They're offering similar compute capacity, but at a fraction of the cost. Nvidia's GPUs, such as the B200, that costs around $40,000. AMD's GPUs cost around $10,000 to $15,000. But coming back to this chart on the left, we see that Nvidia still has a dominant market share of around 92% in the data center GPU space. So why is that the case? If we have these competitors out there in the market, why does Nvidia still hold this essential monopoly within GPUs for now? The answer is really to their software stack, which is called CUDA. CUDA essentially is it allows any type of developer out there to use any type of programming language to use on their GPUs. So it doesn't restrict people, within graphics just to use Nvidia's GPUs. Any type of developer can use that. But what we're seeing with the likes of AMD, they're developing their own software stack to increase the take-up of their chips. Recently we've seen Meta and Microsoft announce that they will use AMD's MI300X as an alternative to the more expensive Nvidia GPUs as well. On Google's side, they have a chip as well. Last night we saw Apple announce that they will be using some of their chips to develop AI models. So we can see that the whole industry is shifting slowly away from not just Nvidia, but to these other competitors as well. Last night, we also saw AMD report their earnings. The sales of their chips have hit $1 billion, and the stock is up around 6 to 7% in after hours. But we do not know what the composition of this market share will look like over time. Will Nvidia continue to retain that monopoly, or will they slowly drop off and then AMD or Intel picks up their market share? Time will tell. I think that overall competition within the industry is beneficial because it lowers the cost of everyday people and enterprises to access leading edge AI applications. So this comes to the next section. If it's really difficult to determine who will win the AI race, whether it's Nvidia, AMD, Google, or Intel, the next question is, can you identify tomorrow's heroes? Are there any signs that we can look at or metrics that will help determine a company's future success? Let's turn to Microsoft and their example back in 2013. So in 2013, there was a Bloomberg article which was titled, "Microsoft's useful life may be near its end." During this time, many questioned if Microsoft would survive because its business looked like it would be the latest victim of what we call the innovator's dilemma. This is essentially where a business will protect its core segments, but it fails to innovate as other disruptors come into the industry. So in Microsoft's case, they were very cognizant of protecting their PC business, but they ultimately missed out on growth within mobile. So mobile devices such as the Apple iPhone, they launched that in around 2007 to 2008. And Microsoft essentially missed out on that opportunity to capture that growing segment, which they ultimately lost. So Steve Ballmer was the CEO from 2000 to 2014, And there was a lot of sort of negative sentiment around whether Microsoft would continue being a leader within the tech industry. So during Ballmer's tenure, Microsoft stock was actually down 20%. But we know that subsequently Microsoft has been on a tear. It's one of the biggest companies in the world, and it's grown exponentially since 2014. So again, coming back to the question, what metrics, if anything, could we have looked at that would have eventuated in Microsoft's future success? Well, 2 years earlier, Microsoft actually ranked 5th globally for R&D spending. And of this amount, around 90% or $8.5 billion was being spent on cloud computing technology, which was seeking to disrupt their own locally stored enterprise model. So when we move to this next chart here, this just shows who the largest R&D spenders were from 2011 to 2014. We can see Microsoft up there amongst Samsung. Microsoft spent around $40 billion in R&D alone, compared to some of other major conglomerates like Novartis and Volkswagen in the healthcare and auto space. So R&D is one big sign that investors can look at as to whether a business will continue to grow future revenue sources that they can capitalize on. And we can see this here. Microsoft growth was really driven by strong R&D. Their quarterly revenue growth has consistently been trending upwards over time as they've invested year on year going forward. Compared to Exxon, you can see Exxon's quarterly revenues have been a bit whipsawed. There's no real correlation between their revenues and R&D expenses. So over time, when Microsoft transitioned from a business solely focused on enterprise PC to gaming, search, cloud, cybersecurity, and AI, naturally they've been able to encapsulate revenue sources from these different segments. We saw last night actually with Microsoft reporting their earnings, the stock has come off a little bit. It's down about 6% in after hours trading, but there's actually a lot of positive signs in their earnings report. Cloud is increasingly having a big payoff for the company. It did sell off just because the growth rate within the cloud revenue segment did come off a bit. And when I say come off a bit, they're still growing their Azure business 29% year on year for the quarter. The market was expecting 30%, and the quarter prior to that was 31%. So we can see that the environment for big tech in general, there is such a high expectation for these companies to continue growing and growing. But if you think about the base that they're starting at, it is very high. They're generating billions of dollars in revenues. In cloud alone, Microsoft generated $29 billion for the second quarter, which they reported overnight. So you can see that coming off from a high base, growing 29% year on year, that's still a very positive sign for these big tech companies. Within that growth rate of 29%, Microsoft actually reported that about 8 percentage points of that was attributable to AI. And that's up from 7 percentage points from the prior quarter. So cloud is really benefiting from the tailwinds in generative AI over the past couple of years. So that's something for investors to potentially consider. Moving beyond R&D and organic growth opportunities, big tech also have invested heavily across the startup and VC land, looking into inorganic growth opportunities. The reason why big tech may want to invest or acquire a startup is because strategic investments like this will enable them to monetize AI tools by adding incremental demand to their existing products and platforms. As an example, we know that Microsoft purchased OpenAI. OpenAI is being used in Apple's iPhone for the next generation models. So anyone with an iPhone 15, 16 going forward when they release, that will have Apple Intelligence incorporated in the phone. That's a separate large language model to OpenAI's one, but there is an option where investors can switch between these two models. I bring this up for a reason because, Apple has really benefited from this news, and without Microsoft having purchased OpenAI, they may not have had the infrastructure to develop this leading edge model. And so that brings me to the second point. For venture capital companies like OpenAI, Anthropic, Databricks, etc., these big tech companies really are amongst the few partners with the capital and infrastructure to support their efforts. When I think about the current market environment that we're currently in, though, I think that with all this M&A activity that has happened during 2021, 2022, when rates were lower at the time, there is a lot of questions around regulation and antitrust concerns. For example, we saw Wiz, which is a Israeli global cybersecurity company. They rejected a $23 billion offer from Google. And this is a huge amount to decline. And it's something that can't be ignored. And the reason why was because there was concern around bringing in attention from the FTC, which is the Fair Trade Commission in America, and the Department of Justice as well. The costs involved if you ever end up in a antitrust lawsuit may potentially weigh down so significantly that it brings someone like a Wiz to reject $23 billion. Having said that, I think that there may be tailwinds potentially with Trump's running mate JD Vance. He was a former venture capitalist in Silicon Valley for about 5 years. There might be political support and policy packages for venture capital. I think that the market also has concerns around whether there would be a breakup of the monopoly of big tech. But I generally think that a Republican Party is pro-market and less rigorous on regulation than a Democratic Party. Enough politics aside, though, if you wanted to access, a global portfolio of companies that really spend their earnings and budgets on R&D or research and development, I'm sure many of you know the NASDAQ index. We have a ETF, which is the NASDAQ 100 ETF or NDQ that tracks this index. And so this chart just shows here how much these companies within the NASDAQ spend on research and development. 11.7% is the percentage of their sales that they spend on R&D, and that compares to the S&P 500, taking away the NASDAQ 100 stocks. The percentage of sales that they spend on R&D is only around 1.8%. So that's a six and a half time increase. And we know that from the Microsoft example, R&D is really a key driver of innovation and economic growth. So that's why we've seen that price discrepancy between the NASDAQ 100 and S&P 500. It's really because the companies have invested for their future success. And this chart just shows the top 10 constituents by the trailing 12-month R&D expenditures that they've had. So naturally, the Magnificent Seven are sort of your top 7 stocks, followed by Qualcomm and Cisco, AstraZeneca, for example. You can see that these companies, again, they're spending huge amounts on R&D. For example, Meta, they spent $40 billion on research and development over the past 12 months, but as a percentage of their sales, that's at 27%. That's more than a quarter of every money that they take in being spent to things like data servers, infrastructure networks, and servers. They know that if they don't spend money on this critical infrastructure, then they'll fall behind in developing, leading edge AI models. So it's very critical for them to continue investing for the foreseeable future. And as I said before, we know that the story or the correlation between R&D is very highly correlated to both revenues and earnings. So this chart shows here the NASDAQ 100 compared to the MSCI World and ASX 200. You can see this exponential rise in R&D expenditures from 2013 to now. It's really increased, and that's followed a similar trend with revenue and earnings. So whilst there are questions to the earning sustainability of US equities, as I've touched on at the start of the webinar, for now, I think that the earnings growth over the next year, it's still forecast to be strong. So this chart shows the consensus 1 year forward EPS growth rate. EPS just stands for earnings per share. We can see that they're expected to grow 21% year on year, and that compares to something like 4% for the MSCI World and ASX 200. So yes, the market is anticipating earnings growth for the Magnificent Seven to slow down, but as I've said before, it's coming off from a very high base. So as the earnings growth rate slows down incrementally for the Magnificent Seven, we've seen positive revisions to earnings growth for the other 493 companies, being the S&P 493. So that's this kind of backdrop that we're in right now. But I'm sure many of you have tuned into this webinar to really delve into, well, if there is so much attention on Magnificent Seven, Nvidia, Tesla, all these big tech companies, are there really other opportunities that we can monetize beyond this set of stocks? And there certainly is. We know that with cloud revenue growth, that has accelerated over time. So this chart shows the cloud segments of Microsoft, Google, and Amazon from 2015 to now. You can see this exponential rise in cloud revenue as generative AI has slowly taken off. There was a slight pullback in cloud revenues in the few quarters of 2023. There was a cost-cutting sort of trend within the industry, but I don't typically view this as a negative. I think that it's really honed these companies' focus on protecting margins, and margins have actually increased for Google within their cloud revenue segment. So Google last week, when they reported earnings, they hit $10 billion in the cloud segment, but at the same time, they were able to reduce costs as well. So the margins improved incrementally. I think ultimately, it's rare that people or enterprises will use these service providers in isolation. We know that its cloud services will probably be used in the same way that we use different pieces of software for different applications. On your laptop or PC, you might be using, say, Adobe, Salesforce, Microsoft suite of services. And I think cloud will be viewed in a similar way. People might be using Google for BigQuery, which is a data analytics tool, Amazon Web Services for web hosting, and also Microsoft's Copilot for programmers out there. So it assists with the programming journey for those software engineers. So, I don't think that these cloud services will be used in isolation, but more so collectively, which should benefit all these companies as we go forward. When we think about the supply chain for GPUs and semiconductor chips, we can break this down into the upstream segment and the downstream segment. The core players are being your big tech companies, Magnificent Seven. So they're within the search, social, cloud, and enterprise areas. But I think investors may not be as aware of the upstream and downstream segments that AI is also encapsulating. So in the upstream segment, we're seeing things like TSMC and ASML in there. So TSMC is a semiconductor manufacturer. They're critically important for designers like Nvidia, Intel, and AMD. And then ASML provides the machines that TSMC will use to make those chips. Data centers and power generation is another growing trend. In order for companies to build their models, more and more data needs to be stored. So data servers are becoming incrementally important. They need to store more GPUs and servers, and that requires space. So these companies are spending billions of dollars as well on data centers. In the downstream component, there are a couple of thematics as well out there that AI is seeing a beneficiary in. So robotics and automation is one, and also cybersecurity as well. On the upstream segment, delving into the componentry and manufacturing side of semiconductor chips, this chart just shows Nvidia's cost of goods sold. So we can see that a majority of it does go to TSMC, Wistron, and SK Hynix. So if I just break this down one by one, as I said, TSMC is the world's leading semiconductor foundry. They're responsible for manufacturing over 90% of the world's advanced chip manufacturing capabilities. You have Wistron as well. Wistron is an electronics company that specializes in product design and manufacturing, and followed by SK Hynix. SK Hynix falls in the same bucket as Samsung. They are an electronic supplier that specializes in what we call DRAM, or dynamic random access memory, and flash memory. On SK Hynix, it's really important for the industry. Companies like Nvidia will rely on memory chips because, as we know, if AI models are to become more advanced, they do need to build and store more data. And with more data, there needs to be more storage. So there is a growing trend to a new piece of memory technology out there called HBM, or high bandwidth memory. Essentially what that means in layman's terms is that on a silicon wafer chip, they will stack up 8 different DRAM chips into what we call HBM. And so the industry is thinking of different ways that they can store more and more data onto a smaller size chip. And you're seeing, as a result, advanced computing capabilities, but at lower and lower costs over time. And just coming back to TSMC, as I said, they essentially have a monopoly in advanced chip manufacturing. And the reason why is because they have the right nodes, or what we call. So they have 7 nanometer, 5, and 3 nanometer. Essentially what that means is that it is a certain size of the chip which an iPhone or a laptop will be built on. These are advanced nodes, as the industry calls them. And so it's very difficult to come off these nodes because TSMC often has long-term contracts with customers like Apple and Nvidia, for example. And that helps ensures that their revenues, at least for TSMC, are locked in for the next 1 to 2 years. In fact, TSMC, in their latest earnings report, they actually confirmed that supply is very, very tight, as quoted by their CEO, coming into 2025. And if that's certainly the case, we should see a pickup in revenues over that time frame. TSMC did beat their earnings estimates for the second quarter of 2024, and as a result, their share price has rallied since then. So that's the upstream segment. We can see that as a result, TSMC's fundamentals have done extremely well. So delving into their earnings report a bit more, they did report that high performance computing chips, or chips used for AI, that now contributes about more than half of their sales. Smartphones used to be more because they developed chips for the Apple iPhone, but slowly over time, it's ticked up to 52% for high performance computing, and smartphones have shrunk to 1/3. It is a fairly diversified revenue stream, but we can see it's incrementally coming from AI applications. On the sales side, we can see that TSMC sales, their quarterly revenues, that's more than doubled since 2020. They generated around $300 billion. This is in Taiwanese dollars, to over $600 billion in the most recent quarter. So TSMC is a natural beneficiary of this whole AI thematic. And these companies, for those interested, they can be found in our ETF called Asia. Asia is our BetaShares Asia Technology Tigers ETF. So it does have exposures to companies like TSMC, Samsung, and SK Hynix. So for those investors who are interested in the upstream or componentry side of the whole AI industry, then Asia might make sense as an investment vehicle. On the downstream component, I mentioned robotics and cybersecurity. We've seen a general rise in populism and protectionist policy, which is bringing manufacturing onshore. And so with that, there has been a boom in construction in things like factories, which have been incentivized by the CHIPS Act, the IRA Act, and the data center AI boom as well. I think that ultimately productivity is how economies will continue growing. So automation will likely remain essential, and AI will be critical to ensure that productivity does increase. In Australia, labor productivity fell actually by 3.5% in the 2022-2023 financial year. So it's not only in countries like the US where you're seeing this huge increase in construction spending that AI has to be implemented, but also in countries where productivity is falling short, like Australia. I think that technologies like AI can be also extremely important for us to consider. So how is AI revolutionizing the industrial automation scene? There are 3 points here. The first one being on new applications. So AI is sort of incorporating situational awareness into industrial robots. These robots essentially have vision or touch awareness. And so that means that they can be used in new environments and work alongside humans as well. AI also makes things easier to deploy. AI-enabled robots can be trained without specialist programming skills, and that increases the potential users and businesses that can leverage the technology. And then finally, we have digital twins as well. But I wanted to touch on how some of these leading companies are incorporating AI from these different bullet points. Keyence is one example. So they provide sensors that can help determine whether a product is faulty within their supply chains. So if you think about, say, a car manufacturer, they're building these cars, and towards the end, they need to do a quality check to ensure whether the car, whether the wheel or the chassis of the body is faulty or not. And so Keyence develops lasers, sensors, and whatnot that can automatically scan whether they're faulty. And so that increases the quality of the cars being produced and the yield as well. So a company like Keyence is improving productivity and quality assurance within the auto space, but also other industries as well. A couple other companies, C3 AI and UiPath. With C3, they run a subscription-based model. They help enterprises build AI applications. And UiPath, they develop what we call robotic process automation, or RPA. Think about, all the sort of digital things that you do on a day-to-day basis on your laptop, whether you have to download data every day or extract text, etc. These guys essentially developed a technology that will enable you to focus on more high value added tasks, and the robot will take care of these low value, high volume, repetitive tasks. So UiPath is slowly making inroads to increase productivity, at least within the white collar industry space. Cybersecurity is another big area that we're seeing investors turn their heads to. I think that within software, cybersecurity is probably the most defensible areas because CIOs are unlikely to cut their spend regardless of what economic cycle we're in. Data is so important for businesses because you gain analytics on how you can sell and optimize certain products to your base. And so businesses really can't afford to have that data being prone to being attacked by bad adversaries and actors out there. So regardless of budgets, economic cycles we're in, we've tended to see corporations spending consistently on cybersecurity year on year, as opposed to other segments. So this chart shows the projects with the largest spend increases in 2024. We can see that AI, machine learning, security software, and digital transformation are some of the top 3 areas that CIOs have said that they will increase their spending budgets in. In security, around 11% of CIOs interviewed said that they would increase their spending budgets on cybersecurity. And on the flip side, it is also an area of software which is least likely to be cut from their budgets as well. So why is there a growing reliance on cyber companies? I think there are 3 main points. Firstly, there's a cyber professional shortage. There are, a shrinking number of global cybersecurity professionals, with 2/3 of companies lacking the staff needed to prevent security issues. So companies like CrowdStrike, I'm sure many of you are aware of the outage that happened a few weeks ago. That wasn't a cyber attack. It was really a systems outage, but they have a tool called Charlotte AI, and that helps with endpoint security. So essentially, any devices like your laptop or your mobile phone, it will consistently run in the background, and if there's any sort of suspicious activity that happens, it will automatically send a response to combat that. And so it reduces the reliance of having a human software or cybersecurity professional doing that for you. The second point is a growing threat from AI. So obviously with AI, we're seeing positive tailwinds to productivity, cost reductions as well. But with that, I think that there will also be, increasingly bad actors as well, because those type of organizations or whatnot, they can use the very same tools that AI provides, but in a negative way. So that's the second point on why cybersecurity has become front of mind for many investors. And then thirdly, companies are really not set up for the evolving landscape. The number of organizations that maintain a minimum viable cyber reliance is down 30% in this year alone, due to the evolving nature of threats. They've become more advanced as they're using AI tools to try to hack different systems. So what are cyber giants doing? I talked about CrowdStrike. Cisco is another example. We talked about that earlier in the webinar. Yes, they are predominantly in the network, hardware, and server space, but they actually acquired a company called Splunk recently. So although a majority of their revenue base isn't in cybersecurity, they do have a small segment through Splunk to encapsulate that trend. And then with Palo Alto, again, they focus on firewall and network security. So they essentially protect your company's network or your personal network from any unauthorized access, modification, or misuse as well. So CrowdStrike and Palo Alto, yes, they're both cyber giants, but they operate in slightly different segments within the cybersecurity realm. So what does this all mean for Australian investors? How can investors implement, some of these ideas, NASDAQ 100, Asia within their portfolios? The first part is that NASDAQ isn't just US technology. I think that there's been a stereotype and focus that it is. Yes, the index is weighted more to IT and technology, but it's important to note that in terms of the revenue base, you can see that it is very diversified by region. The NASDAQ 100 has a very similar revenue exposure to the MSCI World. And you can see that that can really benefit as different countries evolve within their economic cycles at different times. The NASDAQ 100 is really well diversified in that aspect. So that's one point to consider. The NASDAQ is really a global exposure, not just US tech. And then secondly, on complementing Australian investors' portfolios, more often than not, Australians have a home country bias, so they typically hold more Australian equities than, say, global equities and US equities. We know that the Australian market is very heavily biased to industries like mining and financials. On the flip side, the NASDAQ 100 has a very significant underweight to those industries and more of an overweight to IT and communication services. So when you blend those two exposures together, you're getting a really nice diversified portfolio in terms of industry exposure. And so you're not being whipsawed if one industry performs poorly and the other does badly, and the other does greatly as well. You're getting a nice consistent exposure, which will help you through different economic cycles as well. So in terms of fund implementation, some of the companies that I've talked about, Nvidia, Keyence, these are companies within our RBTZ fund, which is our Global Robotics and Artificial Intelligence ETF. There's about 42 stocks in there, and the fees on that are 57 basis points. So, that's a really good fund out there if you wanted to gain exposure to that whole robotic and automation thematic that I touched upon. And then secondly, we also have Hack. Hack is our one of our biggest thematic funds out there. It's our global cybersecurity ETF. It holds companies like Cisco, Palo Alto, and CrowdStrike, which I discussed as well. The number of companies in there are around the 30 mark, and the fees on that are 67 basis points. You're getting a really nice diversified exposure to the leading global cybersecurity companies within that space. And interesting with Hack, Hack compared to the NASDAQ hasn't been as variable and has experienced less drawdowns than the NASDAQ. And the reason why comes back to that point when I showed the Morgan Stanley CIO survey, where the spending budgets on cybersecurity will unlikely be cut regardless of what economic cycle we're in. And so Hack surprisingly has been fairly defensible in terms of investment returns as well. And just finally, I just wanted to wrap off on other things to consider. Obviously, there are investment risks involved with portfolios. It can go up and down. There's no future guarantee of future performance. That is, past performance can't be guaranteed, and this is just general information only. We also launched our BetaShares Direct platform. It really is a zero-cost brokerage platform, and you can trade any ETF on it, not just BetaShares. And you can download BetaShares Direct through the Apple App Store or on Google Play. You can also access our autopilot portfolios in case you wanted, a nice diversified portfolio, which was constructed by our investment committee body. So just in case for investors who's not sure where to start, and that might be a suitable option. But thanks so much everyone for joining this webinar. I had a lot of fun talking about AI and technology and the different investment opportunities out there. It's a extremely important space, and I'm personally very excited to see what it has for the next 5-10 years. So we'll move on to questions that you guys have.
Thank you, Hugh. What an entirely fascinating conversation. I think I always take something out of every session. It's continuously evolving. And we did have a number of questions come through, and I think this one's something I'd like to understand a bit more as well. So, the AI winners, and should they succeed, how disruptive will they be to the everyday person, not just in everyday lives, but in the workplace, you know, within government, running businesses and the like? Can you share a bit more on that?
Sure. Yeah, I think that definitely AI has been disruptive, but I don't think it's in the sense that it's replacing the labor force and whatnot. I actually think that AI will be more of a complement to our existing workloads, and it is definitely across our personal lives, at work, and etc. You know, at work, for example, in the software industry, programmers are using Microsoft Copilot to assist with their programming efforts there. They're not replacing software engineers by any means. Yes, that might be a possibility in the future, but for now, it's really been a complement. And in our everyday lives, you know, I'm sure many of you have tried OpenAI or Perplexity, Anthropic, etc. They're helping you to enhance your existing workloads and improve productivity. You know, for example, there might be a chart or analysis that I need to do on Excel. I might just ask OpenAI to help me out on that. So instead of spending 10 to 15 minutes, you know, I save all of that time because I gave it to OpenAI to do. So yes, AI is and has been very disruptive so far, but you know, it will definitely take a few more years at least to replace you know, human labor. So I think for now we are working in tandem with AI, Laura.
Thank you. Gone are the days where I could save 1 or 2 documents on a floppy disk. The world just continues to change. Are you able to just quickly once again go over all the ETFs that provide exposure to AI, inclusive of any ESG ones as well?
Yeah, sure. So the three, well, the four really I talked on was the Nasdaq 100. I say that because obviously the biggest innovators are on that exchange, and the Magnificent Seven have a substantial weighting in there. It's really home to global innovators within the whole world, really. So Nasdaq 100, NDQ is our fund. Asia is another fund if investors wanted to get upstream exposure to the manufacturing and componentry side of the semi industry. So that had companies like TSMC, which is the chip manufacturer, Samsung and SK Hynix as well, which provide memory chips. So that's Asia. We also talked on a couple downstream segments. So robotics and automation, we have our RBTZ fund, and then we also have HACK. HACK is our global cybersecurity fund as well, which is HACK, the ticker.
Thanks, Hugh. Okay, so when we're looking at these stocks, right, they look like they are fully priced now. What are some things that might happen that could bring about a correction and thus enable people to buy in at a more cheaper price?
Yeah, sure. As I said at the start, I think we're definitely at a critical inflection point. I think that, you know, in the last 2 to 3 weeks alone, we've seen the Mag 7 come off quite a bit. I think around 10 to 12% from their highs, whilst the Russell 2000 or a small cap index increased by a similar amount. That wasn't really caused by what we call a left tail event. It was caused by presumably a softer inflation reading or CPI reading. So that was indicative that the economy was in good health, and that would support companies across the board, which included the S&P 493 companies. But you know, I think other factors like obviously politics might be a concern or risk to big tech. Any sort of policies where the FTC and DOJ have their powers increased, if there's increased regulation and scrutiny within that space, there might be a breakup within the big tech space. There might be less M&A activity, as I touched upon, within VC and venture capital. So there might be a slowdown in the advancements and deployments of their existing models. But yeah, I mean, geopolitics is one. Geopolitics doesn't directly affect technology and software, typically affects the real economy and commodity stocks a bit more. But having said that, I think that with geopolitics and what we saw with Israel and in Gaza is that negative sentiment is quite pervasive and it can weigh on stock markets, including the Nasdaq, S&P 500. So, I think there's a couple events that might weigh down on Mag 7 prices over the short to medium term.
Thanks, Hugh. Okay, so another one that I think will be particularly interesting to our listeners today. When we think about robots, we think about AI, we think about all of these new things that's happening. I know we can definitely correlate that to higher energy consumption. The irony in that is that, companies are needing to report on things like CO2 and things like that. So can you discuss a little bit about some of these innovators within the constituents and what that means from an energy consumption perspective?
That's a great question, Laura. I think that energy is going to be a critical sort of focus point in going forward. The reason why is because coming to the upstream side of things, data centers will be and is currently a priority focus for the Magnificent Seven stocks. But with that, there is a huge demand for power demand, and that's going to place a lot of pressure on grids across the world. I think that companies need to be very cognizant of that. I think there are a few Magnificent Seven companies like Amazon which have actually bought outright some energy companies. I think Amazon bought a nuclear power plant in anticipation that the overall energy demand on their GPU capabilities will increase exponentially. So they've actually taken a step forward and started to buy up some of these energy names. There was an interesting report from Goldman Sachs that the compounded annual growth rate of electricity in the US is 2.4% from 2022 to 2030, and that 90 basis points of that, or around 1/3, will be attributable to data centers. So even Mark Zuckerberg, he's noted that energy is the next biggest constraint in order for them to continue going forward within their AI journey. So, that's why technological developments in order to not only increase compute, but also do that at a manageable energy workload, that will be the question as to who will take it all, I think, in my opinion. It's difficult because when you increase the amount of storage, GPU capabilities, etc., as I talked about that HBM memory sort of stack where you're building 8 different memory chips, that increases so much energy and heat dissipation as well. These things can go up to 100 degrees. So if companies can figure out a way where they can not only increase compute capacity, memory storage, but also keeping energy demand fairly low, that's essentially a tick for the industry.
Thank you. Look, we've got about a minute and a half left, but there is a question to do with BetaShares Direct, in specific children accounts and whether children can invest. And I thought I'd just quickly answer that. We are building out, or our developers, I should say, are building out accounts where parents can set up accounts in trust for their children. That won't be happening for a couple of months, about 3. But of course, no one under the age of 18 can buy or sell ETFs on the stock exchange legally as well. So just something to be aware of. If we haven't answered your question, we will send you a response after it's completed. And of course, a recording of this will be on YouTube as well very shortly. Thank you all so much for joining us today. It's been an absolute pleasure, and we will catch you next time.